Today we are talking about Palantir Technologies and why investors should be very cautious. Palantir Technologies has shown promising improvements in its fundamentals, positioning itself on the path to sustain profitability in the long term. Despite these positive developments, the current market valuation seems to have factored in these improvements already. As previously discussed in earlier videos, my outlook on Palantir is optimistic over the long haul. The company's execution of its growth strategy has been impressive, recently achieving GAAP profitability, which is an indication that its business model is effective and on track for consistent profits. The surge in Palantir's stock price has increased investor interest in artificial intelligence ventures. This growth has outpaced the performance of the broader index during the same time frame, reflecting the market's growing enthusiasm for AI-related investments. Palantir unveiled its Q2 2023 earnings a few weeks ago, largely meeting market expectations. While it had exceeded expectations in the previous 2 quarters, this time the share price reaction on earnings day was negative. In Q2 2023, Palantir's revenues reached $533 million, marking a 13% year-on-year increase. Additionally, the company achieved a noteworthy milestone with trailing 12-month revenue surpassing the $2 billion mark for the first time. Despite this progress, Q2 EPS remained modest at 1 cent. These results present a mixed picture. Achieving GAAP profitability amid challenging macroeconomic conditions is a significant achievement. However, concerns arise due to the deceleration in revenue growth. Palantir's growth rate falls significantly short of its medium-term objective of achieving approximately 30% annual growth. Breaking down the revenue figures by segment, U.S. government revenue rose by 10% to $225 million, while U.S. commercial revenues experienced a more robust 20% year-over-year increase, amounting to $103 million. This implies that the U.S. market constitutes about 62% of Palantir's total revenue, with international markets accounting for the remainder. Despite an intensified focus on hiring new sales personnel in the past 18 months, the company's commercial revenue stood at $232 million, reflecting a 10% year-over-year increase. This indicates that while Palantir expanded its customer base, this expansion did not proportionally translate into higher revenue. At the end of June, Palantir boasted 421 total customers, reflecting an impressive 38% year-over-year growth. While this customer growth outpaces revenue growth, it signifies that new customers are allocating fewer resources to Palantir's software solutions. This behavior can be attributed to the prevailing macroeconomic environment where customers prioritize cost-cutting and operational efficiency enhancements rather than increased spending on new data analysis solutions. Nonetheless, the fact that Palantir continues to attract new customers at a healthy pace validates its business strategy, as customer acquisition is often more challenging than deepening engagement with existing clients. The historical pattern of net dollar retention rates above 100% underscores the potential for future revenue growth. This trend indicates that over time, customers tend to increase their expenditure with the company. Although newer customers might initially generate lower revenue than long-term clients, this trend signals that increased engagement and spending may occur in the future. However, the market's expectations for Palantir's revenue growth over the next few years appear to be more subdued compared to the company's own projections. The consensus forecast indicates 2023 revenues of around $2.2 billion, which is a 16% year-over-year increase, followed by approximately $2.63 billion in 2024, which is a 19% increase, and nearly $3.2 billion by 2025, which is a 21% increase. These projections suggest that Palantir is likely to miss its previously set goal of reaching approximately $4 billion in revenue by 2025. Achieving this target would necessitate an annual revenue growth rate of nearly 35% over the next 2 years, an outcome that seems improbable. Palantir's strategic move to hire more salespeople in preceding quarters has been pivotal in maintaining robust revenue growth despite the economic slowdown. Total expenses in the quarter increased by a mere 1.8% year-over-year, primarily attributed to a reduction in stock-based compensation. This prudent approach enabled Palantir to report a positive GAAP operating income of $14 million, marking a second consecutive quarter of positivity. These results underscore Palantir's progress toward enhanced operating sustainability, which positions it favorably for future earnings as economic conditions improve. Looking ahead, Palantir anticipates generating annual revenues of $2 $2.2 billion in 2023, a projection supported by Q2 2023 billings of $603 million, which is an impressive 52% year-over-year growth rate. This promising performance in billings suggests the potential for increased revenue in subsequent quarters. Furthermore, Palantir's recent launch of AIP, an AI-focused platform that complements existing offerings like Foundry and Apollo, reflects the company's bullish outlook on AI and its growth potential. However, the financial impact of AIP and other AI platforms remains uncertain until Palantir discloses specific revenue figures associated with these ventures. Profitability-wise, Palantir's expectation to report consistent positive GAAP net income throughout the year signals the company's trajectory toward achieving its first-ever annual GAAP profit. From a balance sheet perspective, Palantir is in a robust position, boasting over $3 billion in cash and no debt as of June's end. This financial strength allowed the company to announce a share buyback program worth $1 billion, the first since its DPO in 2020. With excess cash and healthy cash flow generation capabilities, it's reasonable to anticipate further share buybacks in the future, which would likely bolster the company's share price. Although Palantir's growth momentum has tapered off in recent quarters, this trend appears more influenced by challenging economic conditions than underlying fundamental issues. The company's continuous growth in customer numbers and improving profitability underscores its efficacy. Notably, the shift in Palantir's valuation from speculative to earnings-based is a favorable evolution. However, with earnings still relatively modest, Palantir's current trading multiple of over 60 times its forward earnings is considered high. Consequently, the most pertinent valuation metric for now remains the enterprise value to revenue ratio, at least until the company generates more substantial earnings. Currently trading at approximately 12 times its enterprise value over its revenue, which is just above its historical average over recent years, Palantir seems reasonably valued at present. Following a robust rally in recent months, the stock's price no longer appears undervalued. Barring a resurgence in growth, further share price re-rating is unlikely in the near term, suggesting sideways movement over the upcoming weeks or months. While Palantir has demonstrated improved business fundamentals in recent quarters, the evident deceleration in growth raises concerns about meeting its ambitious annual revenue growth target. However, the company's growth prospects remain promising, driven by increasing customer count and the potential impact of new AI offerings on customer engagement and growth. Nevertheless, the previously attractive valuation has now diminished, prompting a hold recommendation. For more videos on Palantir Technologies, press the like button and subscribe. With that being said, I wish you happy investing.